Howdy, folks, and welcome to thedailycoin.org. And my name is Rory. Today is Wednesday, August the 19th, 2015, and I have the distinct honor and pleasure of welcoming back Mr. Alasdair Macleod, who is the head of research at goldmoney.com, and he also operates his own website called financeandeconomics.org. How you doing today, Alasdair?
Absolutely fine. Thanks, Rory. It's nice to be with you again.
Well, it's always a pleasure speaking with you, and we have a lot to cover. We've got China, we've got silver, we've got gold, we've got a world falling apart, so let's get started. Is everything good on your side of the pond this morning?
Yeah, it is. I'm looking a little bit better, given that gold is a bit better as well.
Yeah, it looked like it had a little pop this morning, and which is always nice, to the
Yes.
upside instead of the downside.
This is true. We're not used to it on the upside.
No, we're not.
But I think what's doubly interesting is the weakness in the equity markets, because with them sort of falling apart and gold going better, you sort of think, hold on, the correct relationships, risk relationships, may be falling back into place.
Well, we can only hope.
Yeah.
And I wanted to ask you specifically about the devaluation and more importantly the devaluation by the Chinese of the yuan. They did that. Was it 2 times or 3 times?
It was 3 times, followed by a fourth small revaluation upwards.
And the 2 announcements of gold, and I just spoke with Jeff Nielsen on Monday over at bullionbullscanada.com.
Yeah.
And he was saying that the first announcement that they made of the 600 tons or thereabouts, that was a voluntary announcement, and then the second announcement of the little over 19 tons, that looks like that they're purchasing on the open market, and that is a required announcement that they have to make. And what's your take on that?
Well, it's funny you should ask these questions, because that is precisely the subject of the article that I have written, which will be published tomorrow.
Okay.
So I can give you a preview.
Sounds great.
Brilliant. Okay. I think that with both these events, the devaluations and the small changes, or the first of many small changes, I guess, in the level of gold reserves, is nothing to do with China's economic situation. I think it has everything to do with the IMF's, if you like, sort of intent to defer the inclusion of the yuan in the SDR until September 2016. This was something that was announced on the IMF's website on the 4th of August. And what I would read into that is that America in particular is entering into delaying tactics on this decision. The reasons given are completely ridiculous. Like, they've decided to defer the decision so as it doesn't cause problems at the year end. And I mean, this is just complete nonsense.
It is nonsense.
So China, I think, has got the message quite clearly that America is still opposing the internationalization of the yuan, because it does offer an enormous threat to the US dollar's position as the reserve currency, and therefore dollar hegemony. And I think that's what's really driving this. Now, that being the case, I think what China was doing was it was showing America just how powerful internationally and commercially she is. Those small devaluations have triggered absolute chaos in emerging markets. It has had the effect of signaling to all the members of the IMF that all China need do is play around in the foreign exchange markets to upset the domestic economies of the major welfare nations. And this is very important as far as America is concerned, because the Fed is trying very hard to manage a situation where inflation is absolutely absent. It finds that having cut interest rates to zero, that it is having no economic benefit whatsoever. The American economy, meanwhile, is on a knife edge and could easily fall into a slump. Now, that gives us an idea as to the timing and why China has picked this moment to get the message over to everybody in the IMF. Look, you have to agree between yourselves that China's yuan goes into the SDR, or we can create real havoc. You've just had a small taste. We can create real havoc. I think that's what the message was about. When it comes to gold, here again, I think there is a message. Whether the 19 tons came out of purchases in the market, or whether it came from other accounts, non-reserve reserve accounts that the Chinese government have, I think is immaterial. What she is doing is she's just putting in announcements that, yes, we're increasing, we have got gold, and furthermore, we can control the gold market, and we are prepared to use that control to our advantage. Unless that is, America and the other welfare state nations are prepared to work with us towards a common objective. So the message is always, don't cut us out of the SDR, otherwise there's going to be hell to pay.
And I couldn't agree with you more. I mean, Jeff Brown, who Dave Kranzler and I have spoken with on many occasions. He lives in Beijing. He has for the past 10 years. And we asked him what was going on the ground over there. And he said that the Chinese were absolutely, quote, pissed about the snubbing by the IMF of not being included in the SDR. And that confirmed what I'd already believed. And then when I spoke with Jeff on Monday, and now that I'm speaking with you here on Wednesday the 19th, further confirmation of my belief that that was a big part of what happened. And as far as the gold is concerned, it's a very interesting analysis of what you just presented there, Alasdair. And I think that I wanted to ask you about if the Chinese are not included in the SDR in a more timely manner, not September of 2016, but sometime in the next few months, in the next month or so, actually. Do you think that there's a possibility that they're going to start dumping T-bills, or that they're going to pull more gold out of their safe account or the other non-reserve account and start moving them into their reserve account, and say, because we already know that they're going to take control of the pricing mechanism, and that's coming up within the next month or so. I mean, it could happen any time. And it just seems like there's a lot of moving parts right now, and that China has all of the positives and the West has all of the negatives. Or am I completely off base here?
No, I don't think you are off base. It's a binary situation, if you like, in the sense that either the West works with China towards China's objectives, or she doesn't. And the carrot, as far as everybody is concerned, is if they work with China, then there can be a satisfactory mutual outcome. If they work against China, then China will go and pursue her own interests without due regard to the West's interests. And that is not going to be a comfortable thing as far as the West is concerned, particularly when you bear in mind the level of debt that the West has, and Western governments in particular, and the fragile state of the economies that rely on high taxes in order to balance their books. So No, I would agree that you're right. The only thing I would say is that the Chinese do not deliberately embark on a policy of rocking the boat. That is not their style.
Right.
And furthermore, if you do that, then you just work against your own interests. And that's the importance of this decision, because if America, and it's got to be America in this, by the way, if America excludes the yuan from the SDR, then that very clearly tells the Chinese there's no point in continuing along the line of trying to work on a cooperative basis with the West and with the IMF. She would be far better retreating into the things that she has set up, the AIIB, the new BRICS Bank, and funding those, which brings in your point about selling treasuries, by the way, rather than trying to cooperate on the international stage. It's a very, very important breakpoint, this. And I do expect, incidentally, the IMF to come on side on this one, because I think the pressure from America's allies within the IMF is going to be very, very strong for America to back down. Because they realize what's going on. America also realizes what's going on. But America's in a very difficult position because she's pursued a policy of trying to keep the Chinese out of the ultimate power, if you like, of having a tradable currency. So this, to her, in a sense, is a last-ditch attempt to try and stop something happening, which actually we can all see is inevitable anyway. And that's really where we are. So America has got to give in. If she doesn't give in, then it's going to be chaos. And I think you'll find that China will be reading the signals coming out of her intelligence services, her contacts in the IMF, about how this is progressing very, very carefully. And if they get the feeling that America is still against allowing the yuan to join the SDR before this year end, then I think you will get further attempts from China to rock the international currency boat. So it's going to be quite a difficult, tense time to watch. And I think as far as markets as a whole are concerned, perhaps the understanding or growing understanding that this is a risk now, which has got to be factored into asset prices, we're beginning to see that. We're beginning to see that equity markets are falling really quite heavily. Most of them are now underneath their 200-day moving average, or if they're not there, they're on their way there. They're under a death cross of the 50-day moving average, crossing below the 200-day moving average, with the price of the index below those two moving averages. This is the classic death cross. And of course, with markets which are so incredibly overvalued, particularly equity and bond markets, you have a situation where it's not going to take very, very much of an international currency problem to really destabilize the markets, and destabilize them in quite a dramatic fashion. So these are very difficult times, and I suspect even within the US government, you have got the Fed officials beginning to think, oh, hold on a minute, that we need this like a hole in the head. And the strategists in Washington, getting really sort of stuck in the mud in terms of their approach, and trying to persist with the previous approach, or the current approach, if you like, of the dollar is king, and we're not going to let anyone else who's going to threaten it. So this is not an easy time.
It sounds like that this could potentially be a trigger point for not just monetary bombs, but real bombs, live bombs.
Well, I think that's going too far, and I jolly well hope it remains a bridge too far. I don't see that at the moment. Okay. And I mean, one of the great things about the nuclear umbrella is that it does take off the table the idea that you can provoke someone into military action, because if you get the big beasts deciding to have a go at each other, we're all finished, including the big beasts. Yeah. So let us hope that the concept of the nuclear umbrella will continue to work through these very difficult times. I mean, having said that, I would not rule out an escalation of disputes, for example, over the Spratly Islands and that sort of thing. And I noticed that the Ukraine seems to be bubbling up again.
Yes.
I noticed that Vladimir Putin paid a visit to the Crimea yesterday and the day before. So you can see that, there is, if you like, the potential for political tensions to build up as well. But I think at the moment to say that they have an awful lot to do with what's going on the monetary side, I think is probably, we don't have enough evidence to say that yet. But I would just look at the Chinese situation, and I think what the Chinese are doing is they are getting the message out loud and clear that they are the real power when it comes to global trade, more so than America. And that is what we're seeing.
Well, and I think that also that part of what's going on as far as with China and making their stand is that they're looking at the same thing that you and I look at. I mean, we see there's I don't know if you're familiar with Wolf Richter or not over at wolfstreet.com, but he does a bi-monthly analysis of the containerized shipping freight that comes out of China, and he looks at that, and it has absolutely fallen off a cliff. I mean, it has done a nosedive. And that, what I like to do is look at his analysis of that particular piece of economic information, because it cannot be rigged, along with the BDI, the Baltic Dry Index. And if you take those two and look at them side by side, you can see that the global economy doesn't exist, and that China, being the world's manufacturer, has to be looking at that as well. They're seeing that they have product that is not going anywhere, and that we owe them trillions of dollars. And all of a sudden we step up and we say, well, that's nice of you, China, that you want to join the SDR and be part of the global community, but maybe not now is a good time. And so them stepping and China responding with everything that we've just said, it only makes sense. I mean, it makes perfect sense. And as far as it becoming a hot war as opposed to a monetary war, I think that China and Russia and the other BRICS nations as a whole have the ultimate nuclear weapon, and that's our debt, because they could unleash that in the push of a button, and all of a sudden the United States and Europe are in seriously deep trouble.
Yes, I think that may be. I agree with you entirely about what the shipping rates are telling us. And in fact, the Baltic Dry Index, I think ever since 2008, has been telling us that there's been too much shipping capacity for the amount of shipping that's actually taking place. Now, to some extent, it's a function of how many ships, and to some extent, it's a function of the actual underlying trade. But I think more recently, as you point out, I think it has become increasingly obvious it's not so much now a question of overcapacity of shipping, is more a question of the trade isn't there. So I would agree with you entirely on that. But I think what I would do is I would draw a line between the economic effect on China and China's strategy over the SDR and her future. I mean, a lot of the stuff I have seen by mainstream economists has sort of suggested that the devaluation helps China to rebalance her economy. I think it's a load of rubbish, because to have an economic effect, a substantial devaluation would be required, not just a 5% or 4 point whatever percent that we've had. And so that's not what's happening. And devaluation is essentially a Keynesian concept in terms of economic management. And it's far from clear that Chinese leadership embraces Keynesian economics. I mean, otherwise, why would they be encouraging their citizens to acquire gold? Why is it that the state itself has acquired huge amounts of gold? I mean, that is obvious to me. It is not public, I would admit, but my contacts in that part of the world confirm that my analysis on their gold policy is correct, and it is not, therefore, in accordance with Keynesian economics. And of course, China, together with Russia, through the Shanghai Cooperation Organization, is planning an infrastructure revolution, which is going to take in the whole of Asia. And this basically replicates China's economic development from 1980 onwards, but on a far bigger scale. And this is why those in the know jumped at the chance of participating in the financing opportunities through the Asian Infrastructure Investment Bank, which will be the principal financing channel. And I think the last point on this is that China's strategy in the decades to come is to be the provider of high-end products and services to the whole of the Eurasian continent. We're talking about 3 billion people. And that means they have to evolve from a low-cost manufacturer of products for the rest of the world. What this basically means is that China needs the reallocation of capital resources to be released from those legacy industries, the companies that make cheap products for the rest of the world, to be redeployed over a period of time, and probably not a huge period of time, in accordance with her objectives, her medium and long-term objectives. So what is interesting in this is that China has a credit bubble that is deflating, yes. Now, if that happened in a Western economy, we would be in real difficulty because there is no alternative to deflating that bubble or trying to slow it down. If you slow it down, you just strangle the economy for far longer and cause considerably more misery, if you like, over a long period of time rather than facing the reality. China's case is fundamentally different in this respect. She needs those resources to be released to satisfy her long-term plans to reallocate or redirect her economy into creating, if you like, a China across the whole of the Eurasian continent. That is the difference, and that is the point that most economists, I think, in their analysis of the Chinese situation miss. And this is why they seem to think that the devaluation is an indication of the beginning of problems in China, not, as I would have it, an indication that China is rocking the boat in order to ensure that the message gets over to all the members of the IMF as to where the power in trade actually lies.
And
so it's a fascinating situation.
It really is, and that's why I have such high respect for you, Alasdair, because of the way that you just laid that all out. It is beautiful and very easy to understand. And folks, if you don't get it, you never will. And it's just that simple. I mean, if you don't understand that the Shanghai Cooperation Organization is going to roll over Europe and America over the next 10 years, then there's nothing that I can say or do to help you, because it's coming. There's no question about it. And I mean, it's a game changer, big time. I mean, they have all of the power, they have all of the gold, they have all the resources, they have all the manufacturing. What else needs to be said? And they have a plan to deploy all of this across, like you said, across all of Eurasia. I mean, it's incredible. It is incredible. As we sit over here in the West, twiddling our thumbs, going, isn't ZERP great? Isn't QE working like a charm? Isn't life grand for the 1%? It is a beautiful thing. And all you slaves out there, good luck. And that's just not working. It's not working anymore. So, and
well, you raise an interesting point there, I think, in what you're saying, Rory, because we're busy destroying the middle classes, whereas the Asians are creating them.
Exactly. I mean, that's exactly what's happening. I mean, they're building their people up, and we're tearing everybody down. I don't know. I don't get it, but I want to change gears real quick because I want to. I don't want to take up too much more of your time, but I do want to. I would be remiss to not ask you about what's going on with gold and silver on the ground, where you stand in London there, Mr. Macleod. What do you see and what do you hear?
Yeah, the big question.
Yes.
Well, we don't hear a lot. I mean, obviously, there's a lot of back chat going on about, shortages and of physical and all the rest of it. I mean, this has been a situation for some considerable time, um, and I think I would draw attention to one fact, and that is the level of bearishness in the paper markets is now greater than it has ever been. Yet the price fails to move into new low ground. Now, that to me is actually quite a strong technical indication that the market is on the turn. It's an analysis which is sometimes wrong, but generally, I think it is right to say that if you get increased bearishness and the market refuses to go down, watch out. There's a rally ahead. And I feel, looking at what's going on in the market this morning, I mean, we're talking on sort of Wednesday afternoon European time. I see the equity markets falling apart quite sharply. And as I look at it, we've got Wall Street down over 200 points. The FTSE, which is the UK index, is down 124 points, which is 2%. These falls are sort of getting a bit too consistent. And as I said earlier on, you're now looking at these markets below their 200-day moving average, below their 50-day moving averages, and looking like they're definitely in a bear market. Now, if that is the case, what we're seeing is the assets which people have been buying because they are in a rising trend now falling, and the assets which people sell because they are in a falling trend beginning to rise. And in that latter group, I would put gold and silver. There was an interesting attempt to get silver down sharply yesterday. Now, I'm not going to say it was manipulated or anything like that because I've got no evidence as to who was dealing. I haven't seen the tickets. But isn't it interesting that silver gets bashed very, very heavily yesterday, presumably encouraging some people to throw out some bear positions? And what happens today? It recovers almost all the loss that we saw yesterday. If you shorted the market because silver looked really sick yesterday, you would be sick today. And this, to me, is a lovely market which is showing every sign of being on the turn. And so I'm quite happy about it, Rory, all in all.
I'm very happy about it. I mean, it just I would love to see them beat it down some more so that I could get some more on the cheap. I mean, it's just that simple.
Yes.
I mean,
Well, I think you're absolutely right. I mean, the world is made up, I think, of two different types. You've got the people who look at value, the Warren Buffetts of this world. They look at cash flows and things like that. Now, I know it doesn't apply with gold. We make our own assessment of value in gold, and if it's cheap, it makes sense to accumulate it. You've got the other type of investor in this world who will only buy things that are going up and will only sell things that are going down. Now, inevitably, it means that by the time they start buying things that are going up, they've missed the boat. And
yes.
when things are going down, they've got to sell at a loss. Now, when you get an extended run, obviously that is no longer true, but an extended run basically leads to higher levels of complacency, investor complacency. And, I sort of, over the years, I mean, I've been in the investment business since 1970, and, I've come to the conclusion that the people I know who have really sort of become billionaires, and I don't mean the people who've sort of invented something wonderful and stuck with it and turned it into a very successful product. The financial billionaires are basically the people who've gone for value, not the people who go for the trend. Because the people who go for the trend periodically get wiped out. So, they run a sort of a life which is ups and downs like a sawtooth, like saw teeth on a razor. Whereas, the people who chase value, they have cash at the right time to buy things which are sold in desperation by people who can no longer afford to keep them. And that's the position always to be in. And I think broadly that's where we are with precious metals at the moment.
Well, I hope that I know that you're right in that regard. And do you believe, Alistair, with the changing of the guard, if you will, with China having a little bit more say in the pricing mechanism of gold and silver? Well, they're going to start with gold. That's going to have an immediate effect or a soft effect or any effect.
Difficult to say. I think. I mean, obviously, the control of the price by governments has been a feature of well, gold in particular, ever since ever since convertibility has been disallowed. So we've seen it in America since 1934. You could argue that we had it before that, but in 1933, the American citizens were no longer permitted to hold gold. So and you couldn't convert your dollars into gold at the Fed or at your bank or whatever. So that's it's been manipulated ever since then. I think that China's manipulation of the gold price is going to be the interesting one going forward, and to an extent, this does depend, I think, on this application to join the SDR basket. If it is turned down, I think the potential for the gold price could be a lot more immediate than if it was merely left to investors beginning to hedge the mounting risks, if you like, of a collapse in the purchasing power of paper currencies, which incidentally is baked into the cake now, and I see that as almost unavoidable. And if you look at the euro in particular, if we just start with that one, the euro does not have a long history of being used as a paper currency. It only goes back to 2002. As far as individuals are concerned, though it was phased in up to that point. So you have something which is purely artificial. Now, the confidence in something that is artificial without a long history is necessarily considerably more fragile. And I think that it is a lot more likely that a currency like the euro could suddenly find a collapse of confidence in its purchasing power. And this is irrespective, incidentally, of the amount printed by QE, whatever. If that happens, I think that it could well wake up the people who hold other paper currencies to think, hold on, I'm in sterling, I buy and sell things in sterling. What happens if that happens to the pound? What is actually behind the pound? What guarantee have I got that the purchasing power of my pound is going to be the same tomorrow as it is today? And when people start asking these questions and beginning maybe to be frightened that the money that they hold, whether it's in cash or deposit accounts or current accounts or whatever, is immaterial. But if they have got that money sitting there and they start to worry that its purchasing power may erode, then I think that you could have a very, very uncomfortable situation in currencies. Now, obviously, that is going to be the main driver, I think, for gold, because gold does not suffer from that problem. The speed at which this comes about is something which it is partly a factor of the mess, if you like, the governments may make in negotiating with each other, which is why, as I come back to this SDR issue, but if they play everything by the board, and let us assume that America backs down and comes to an accommodation with China, and China is allowed into the SDR, and China stops threatening to destabilize the international currency situation, then it's going to be a matter of time, perhaps slightly longer, before the full potential revaluation of gold measured in paper currencies comes about. But it's not going to stop it happening, and that is the point. Either way, we are at a very, very low price. Gold and silver are excellent value when you compare it to the quantity of dollars or euros or pounds or yen in circulation. And the other thing is that you've got the growing middle classes in Asia. They are turning to gold. They routinely have gold as part of if not the basis, of their savings. And you can see that there is a natural growing demand on that basis alone before the West has any bite at this cherry at all. So it's a fascinating dynamic, and I think we will look back on these times with, I think, great interest, historical interest.
I would agree with that wholeheartedly. And last comment, maybe a question in here, is
Oh,
wouldn't it be in the best interest of China to allow the price to rise? Because as we all know, and as we pointed out in just earlier, the Chinese government has been encouraging their citizenry to acquire gold. So if the price of gold, or I'd like to call it the exchange rate, if the exchange rate of gold rises, then all of a sudden their population is much more wealthy. They have a great deal more wealth than most everybody else in the world.
I think it's probably more an insurance policy for China's population than, at this stage, a deliberate act of policy to revalue gold. China, I have no doubt, would prefer the time that would be given to her if she was part of the SDR. If she's not part of the SDR, then the pace has to accelerate, and she would have to look at alternatives. And I think at that stage, what would happen is that she would have to consider revaluing gold, if for no other reason to cover the losses that she would have on her treasuries. But I think also part of her trans-Asian trading strategy is they will trade in currencies, whether it's yuan or rubles or or rupees or whatever the currencies are, but always with a guarantee in the background of some sort, particularly on long-term trading contracts of the price of gold. Now, in that sense, it does make it obviously it would suit China, who I believe does have very substantial quantities of gold. It would suit China very much to have a far higher gold price.
Yes, yes, it would. And on that note, we will. I'll let you get back to your afternoon, and I certainly appreciate all your time and all your wisdom. And we have been speaking with Mr. Alasdair Macleod, who has his own website, which is financeandeconomics.org, and he is the head of research for goldmoney.com. And you can find his work at both of those websites, and I publish everything that Mr. Macleod writes at thedailycoin.org. And Alasdair, is there anything you would like to leave the audience with, or?
I think we've covered virtually everything that really matters at this moment in time.
Well, I hope that we can get you back on the line before too awful long.
That would be my pleasure, Rory.
Otherwise, have a wonderful rest of the week, and I will talk with you soon.
Thank you.